Okay, everybody, thank you so much for joining for the NYU conference, Capital Markets Conference. I'd like to begin by thanking New York University, the Schack Institute of Real Estate for their sponsorship of the conference. And of course, in this unprecedented year, to be able to bring people together and be able to share our views, particularly as we get to the end of the year here, is obviously wonderful. This is always such a big event. It gives me great pleasure, honor to have a panel to address underwriting in the post-COVID world, and of course to have a superstar panel, to share their thoughts on where we go from here. And I mean, crystal balls will be hugely appreciated. Before I ask you to introduce yourselves, just a couple things. First of all, I guess I should introduce myself. My name is Brian Ward. I'm the CEO of Trimont Real Estate Advisors. We are a global credit manager and servicer. We oversee about $140 billion of our clients' credit around the world from 8 offices. We are going to address 2 things today. Really, we're going to talk about how do we underwrite cash flows in the post-COVID world, and how to underwrite and to think about the capital markets in the post-COVID world. So with me again, superstar cast, and I'd ask you to begin by introducing yourselves. Maybe Marilyn, let's start with you and kind of work our way around clockwise.
Sure. Hi, I'm Marilyn Mawn. I'm an originator at JP Morgan in the investment bank, and I've been at the firm my entire career. I primarily focus on origination in the Northeast and in the hospitality sector, which has made for quite an interesting year. And look forward to discussing the market with you today.
Great, thanks. Elizabeth?
Hi, my name's Elizabeth Martin. I'm president of E.L. Martin Partners. We are office and retail leasing brokers in New York.
Wonderful. Erin?
Hi, Erin Welling. I head up asset management at Argentic. Argentic is a commercial real estate lender. We originate loans through 2 channels primarily: our fixed rate conduit program, as well as our floating rate transitional bridge lending program. We're also active in the CMBS markets and the CLO markets, and we're also a BP's risk retention sponsor.
Wow, you guys have a lot going on. Jeff, next.
Hi, Jeff Beckham with GID Investment Advisors, about a 19 billion AUM investment manager focusing on multifamily and industrial, and also do some large mixed-use development as well. I oversee portfolio management as well as strategy and research.
Thank you. So let's level set before we dive into it. Obviously unprecedented year so far. So many different forces at play. So many unknown unknowns. Have contributed to where we sit. This panel is trying to peel back the onion and think about where do we go from here, and how do we underwrite the various risks that are going on in the marketplace. I've heard a lot of comments. I'm sitting back in our position as credit manager and servicer of things to the effect that while risk, the input has significantly increased, the price to get in is still remaining very, very high, and maybe not reflective of that amount of risk. But here we are, and so as we go forward and we think about how one plays in the markets, it's going to be incredibly tricky, I would imagine. And so let's try and dive into it. I kept the discussion to kind of the next 12 to 24 months max, because I think it's really the relevant window here. The next 9 months are going to be difficult enough as it is, let alone the next 12 to 24 in terms of how we talk about this. So with that, let's start with cash flow. The components of cash flow being income and expenses. And Marilyn, maybe let's start with you in terms of how are you thinking about it for the major asset classes, being multifamily, industrial, office, retail, and hotels. You don't have to cover all of them, but how are you thinking about, or how's JP Morgan thinking about it for this next year?
Absolutely. I think it varies widely amongst the asset classes and primarily on location. If you're multifamily in New York, we're very focused on collections and your expenses around COVID cleaning, and you're cleaning elevators much more frequently. But it's really around that collections, because especially in stabilized, I don't necessarily think the rents are going to go down, but I think your collections are going to go down. where if that same multifamily is located in Texas, I'm not as worried about collections. I think industrial, we all feel really strongly about that market's going to continue to hum along with, you know, incredible demand for last mile space. I think hospitality, the recovery is going to be very K-shaped, I guess, and you'll have the limited service, I think, is starting to come back along the highways. People are driving more, and so you're seeing some increase in the RevPAR there. But I think the big boxes, it's going to take a while for them to come back, right? Because people aren't planning for conferences 24 to 36 months out the way they normally would have, and they've already canceled things through at least the first half of next year. So I think we're going to see the kind of big box hotels take a while to come back.
Okay. I have some questions, but I want to let others chime in. So please, one of you follow on.
Well, I know the retail market is also, it truly has been devastated. But I do believe that once we start to see more of our office tenants coming back into the marketplace, we will also then start to see a recovery of the retail that is surrounding the core office market. You know, you will definitely start to see the recovery of those businesses that rely on having that foot traffic and business.
Okay, Jeff, you were going to say something?
Yeah, I was going to say from the multifamily perspective, we're kind of seeing there's a dichotomy there. So occupancies have held, but when you look at net effective rents, you'll see a discrepancy between renewals and new leases. You know, renewals, you're down, but you're down maybe 5%. On new leases, that's where the bottom has fallen out. And even then, that's regional. So California, new leasing and net effective rent in New York, you know, you could be down 30% in some cases. Whereas in Texas or Atlanta, it's not as dramatic. But again, across the board, new leases are far down over renewals. Okay.
Before I challenge you, I'm going to give Erin a chance here.
Okay.
Yeah, no, I mean, I echo everything you guys said. I think it's, you know, we are always looking at the value of our assets on the asset management side. And it's been, you know, challenging and interesting to kind of look at the changes that have occurred over the past 6 months. I think generally, on the transitional side, there's been a dip, but we're not necessarily changing values. We're kind of just stretching out the time in which the property will reach a stabilized value. So maybe that's a little bit optimistic, but we believe everything is going to come back. It's just a matter of time. And I think that's kind of the big question, Brian, to your earlier point, like, is it 12 months, 24 months, 3 years or longer? Timing is kind of the question mark that no one has the answer to.
Right. Okay, so let's start with multifamily. How do you underwrite multifamily over the next 12 months going forward when you've got a fairly large amount of state support through wage support, through paycheck protection and that we've had, and the potential that Congress might not get a deal done, that the support might not be as robust as people hope, that there might not be as much state support in the income stream? How do you think about, how am I going to underwrite that multifamily project going forward when I know that's a risk? Secondly, how do I underwrite that multifamily project, Jeff, along the lines of when you're talking about the numbers we're seeing are renewals or plummeting, particularly in some of these major metros. So how do you underwrite that risk? How do you underwrite risks associated with transportation, public transportation, particularly in cities like New York, and people are going to be challenged in terms of getting to the city and things like that? How does that impact it? So I'd love to hear your thoughts there on multifamily. And then Elizabeth, I want to kind of press you a little bit with respect to retail and also some of the comments around hospitality. But let's take the multifamily question first.
You know, it's interesting, you know, just looking at a deal, an investment committee that just came up today, bidders are literally just underwriting through COVID. Pricing, especially suburban multifamily, pricing is higher than it was pre-COVID. Part of that, I'm sure, is just the scarcity premium. You know, there aren't a lot of deals out there, but there's a lot of capital. but it appears people are just looking straight through and assuming COVID will be over in 6 months. We're taking an approach where you've really got to, at least for the next 12 to 18 months, underwrite significant discounts in terms of lease up if there's vacancy, and even with renewals, then hope that you can tamp that down once you get out to 2022 and beyond. So that's a challenge. Now, urban assets, you don't have to worry about underwriting because there's none on the market, because nobody's focused on those. And the urban assets that we have are really struggling. So there's a big dichotomy now between the urban and suburban. At some point, is there a contrarian play where urban assets, when they do come out, their pricing is so far off and you figure things may eventually bounce back? Maybe, but we haven't seen that yet, and we're probably a little ways away from that happening. But at the end of the day, underwriting, you have to take some sort of view as to how long COVID will last. I don't think anybody thinks it lasts forever, but is it 2 years? Is it 1 year? Is it 18 months? You have to start there and have a view, and then underwrite some sort of ramp up from there.
Okay, so let me ask all of you, if people are just underwriting through, is it because they are acknowledging that if I really want to be an investor, I really want to be a buyer in this market, unless I underwrite through, I'm never going to be competitive, and then I'm then going to support it with very, very low cost of capital in terms of leverage? Is that basically what people are thinking here?
I think it again goes back to what market you're in, right? I think you can underwrite through if you're in Houston, where things were impacted a bit, but not devastated the way they were in Manhattan. We looked initially at a deal that was a recap in February, and then they came back to us in June at a 30% discount from what the recap valuation was going to be in February, and the deal still hasn't gotten done because they're still going back and forth on it. But I think it goes back to kind of where do you bottom out your collections on the multifamily side.
Okay. Who else got thoughts here? Anything?
Yeah, I mean, I would just add, like, on the multifamily side, across our portfolio, I think across asset types, collections have been relatively strong. With government intervention and the relief funds that have come in, we saw a dip in like April, May, but a pretty quick bounce back. So we've been pretty positive about our multifamily positions. I don't think we've written any of them down, thank goodness. But so far, so good.
Okay.
We've seen a lot of slow pay on the multi as opposed to, not paying at all. If you look at what the collections were in March, it was a disaster. But then by June, those March payments had started to trickle in. So it's kind of catch up.
We've seen a lot of sponsors really help tenants find those programs and access them, which obviously benefits their cash flow and then their ability to debt service. But sponsors have been, very proactive, knowing that they can't evict tenants in a lot of markets. It's been, to their benefit to help their tenants get those funds.
Okay. While I would agree from our perspective, being long on multifamily, I mean, the fundamental demographics are certainly there, right? And housing will always be in demand in one form or another. I can't remember which one of you made the K-shaped comment, but that feels like really, really relevant to the multifamily space, that we've got kind of this inverted K-shape happening. Whereas, if you would ask me during normal times, would I ever bet against multifamily in Manhattan or, just the 5 boroughs, I'd say not on your life. But at least for now, it sounds like there's going to be some hardship over the next 12 to 24 months. But it sounds like people are underwriting through it. Is that a fair way to say it for Manhattan too, or not really?
I think people are being cautious in Manhattan.
Yeah.
Okay.
Yeah.
Okay. All right. Well, look, I think that's an interesting discussion on multis. Let's switch it over to retail, where I can get into the realm of Elizabeth's expertise here in terms of how we think about retail going forward. I mean, obviously, you would have to be kind of completely cut off from the news for the last decade if you didn't have some appreciation for the onslaught of challenges that retail has faced and obviously the emergence of e-commerce and its impacts on retail. I have talked about COVID potentially as being the great accelerator of change. And one of those being maybe the heightened acceleration of e-commerce and its impacts on retail. But Elizabeth, I'd like to get your thoughts on how people should be thinking about retail in this next 12 to 24 months, given all that's occurred and this acceleration of change that I believe is happening.
I can't agree with you more. Retail was already struggling, and then to have COVID hit, it was, as you said, just an accelerator that has really now plummeted those rents and the users that are looking for retail. But I still say I don't bet against New York, especially. And we have gone through so many issues when it came to 9/11, when it was Hurricane Sandy, and the markets come back. And I do think this is probably an 18 to 24 month play with the downturn in retail rents. But people will start coming back. When they start coming back to the offices, when families feel more comfortable with coming back from, some of them have gone now to the suburbs and the surrounding areas. And when they start realizing that the suburbs aren't as convenient, and there's some issues of going far out, that they will start coming back. Once you start seeing that trend, I do then believe you will start seeing more retailers, and you will see more entrepreneurs willing to take the risk, having a product that they want to market, and they will be willing to take space. So I give it 18 to 24 months. I was also very encouraged to hear that, Pfizer may have a vaccine that is 90% effective based upon today's news. So that is a very good, that's a very good part of maybe that we will start to really see a trend of coming back to the city.
Certainly, some hope for optimism, right? In terms of where that might come. I mean, I think it's going to be. My guess is it will be late next year before we start to really see, if in fact the vaccine does have legs, before we start to see its benefits. So is there any price discovery happening right now in retail, or everybody taking a fairly large swath of discount when they're looking at transactions, or how's it going there?
It's funny. It's users are thinking in the line of they're going to get a fire sale, and I haven't seen that happen as much as maybe we would have thought at this point. Prices are decreasing, but owners just want to focus on a good tenant, someone who's credit worthy, and they're willing to give concessions. Especially, I've seen a couple of owners who are willing to say, in the next year, I can give you a break on the rent. And then once this phase starts to, once we get out of the and go into more of a post-COVID environment, then we can start increasing the rent as revenue starts to increase. You hear some owners talking about percentage rent plays, where it would be based upon what you're producing. So you would have a percentage rent now as part of the percentage of the revenue as part of now would be your rent.
So they've scrapped the base rent,
right? In the short term, they're
Okay.
starting to talk about that. So, but that hasn't been historically a way that, especially the New York market, has been priced. So it is contrary to what we have been used to as market norms. But you're starting still to see some retailers who are kind of kicking the tires and getting a sense of, whether or not this is a good time to enter the market, which I'm encouraged by.
Okay, please, someone else dive in here.
We were just looking at a large retail deal, Whole Foods anchored, but lots of other big boxes. And it was really fascinating to look at, how they had done their concessions, but also which stores had increased sales in 2020, which was kind of shocking when you looked at the fast casual restaurants that actually had the curbside pickup already set up pre-COVID. Their sales were up in 2020 because they were now actually getting food out the door faster than they would have in the pre-COVID market. And then, of course, like anybody that had anything to do with the outdoors, their sales were through the roof. Like if you're looking at Athleta or LL Bean or something like that, they all did incredibly well. But then, of course, if you're looking at Ann Taylor or Joseph Banks, they were all a disaster. And so I think people have to be thoughtful about how they dealt with them across their portfolio.
Okay. Jeff, Erin?
Yeah, I would say one of the things we've seen on the asset management side in retail and also office a little bit is kind of the, tenants that needed relief in April, May, June, July, sponsors were giving them free rent in exchange for extending out terms. So it was a way to kind of guarantee, kind of a longer term rent roll in exchange for a few months of relief. So that was kind of one way they were negotiating it, which I think has proved pretty effective. The other thing I wanted to say is that the larger credit tenants we saw throw their weight around early on in terms of asking for rent relief or saying like, we're not paying, give us relief, and call our litigation hotline. There wasn't much we could do. Whereas we saw a lot of the smaller tenants really try to come out of pocket and, meet their obligations. Some, are doing fine now and some are not, unfortunately, but it is interesting to look at these different retail centers, the tenant base, see how, everyone's behaving, and then ultimately how the sponsors are navigating through. But I think, for most of our retail properties, our rent rolls are looking stronger than they were pre-COVID, just in terms of, lease expiration schedules.
Okay.
So you saw the moral hazard almost backwards. That the
Exactly.
that could afford to pay didn't.
Yeah.
We saw the same thing, by the way, but most of our clients weren't buying it. So
I think
Jeff, yeah.
I was just saying also in retail, you have to draw a line between food and dry goods. Whereas I think on the food and the restaurant front, that model, to Elizabeth's point, was broken pre-COVID. Labor costs were rising, margins were razor thin. COVID just literally tipped it over. And I think it's very, very difficult to, put a restaurant or food on base rent, right? Unless it's really low. I think the percentage rent model is going to have to be the way to go. Maybe some hybrid where percentage rent for the first few years to get them going and a conversion to base rent, because it's a really challenged industry, especially the non-chain restaurants. So, for anyone who, landlords have to kind of come to grips if they want that, key restaurant tenant that's going to enhance their office building, treat it almost like an amenity. You're probably not going to make money on it, and that's going to affect valuation in some assets. Could be significantly.
Okay, so let's put grocery anchored aside for a second, because grocery anchored feels like it's done okay through the crisis. Coming back to New York City, and then maybe expanding a little bit, will retailers take less space going forward? Will they, or will they continue to occupy, the big high-end Fifth Avenue and 53rd type of location?
I think it might take just maybe 2 years or so, but I do believe we'll get back to some semblance of normalcy, quote unquote, where your very high-end retailers will want to be on still your Madisons, your Fifths, and they will be once we also get the tourism back, that will make a difference too, and that will help to get the very high-end retailers feeling more comfortable taking additional space.
Is there anything not coming back or anything that's going to get materially reduced in size? It's a question for all of you. I
think restaurants are still, depending on how they're structured. The very, very high-end restaurants may have a little bit of difficulty getting back their clientele. And people have to feel, again, very comfortable with dining inside. Your outdoor venues, your more casual venues, I think will fare a little bit better in this market.
Okay.
Yeah.
I also think your kind of mid-tier clothing is going to need smaller spaces. Like, does H&M need these huge boxes, or Joseph A. Banks? I think you're going to see them reduce their footprints.
Okay. What about the Walgreens, CVS's of the world, and like that? To me, it feels like it's an acceleration of, I suppose, opportunity to buy those types of goods. I suppose maybe with the exception of the prescription that you've got to drive up to the window for. But to me, it feels like it's easier to just go online and buy that stuff today. Are those guys in trouble? And I guess in the same vein, what happens to the big box guys like Best Buy and the like?
Surprisingly, I mean, Best Buy has actually held up strong, through the last few years. I mean, you saw Circuit City, their biggest competitor, disappear, and Best Buy has stayed strong, even, and they've converted their stores in a sense to mini fulfillment centers to a certain extent. So, it seems like there's a place in the market for Best Buy. There probably isn't a space in the market for another electronics big box retailer. So if they can keep navigating that correctly, I think they could be here to stay. But I to your point, there, a space I think is going to be looked at very differently for retailers going forward. The Walgreens, their pharmacy is their anchor. That what's the one thing that's going to get people in the store? Well, you got to pick up your drugs. So that may sustain them as they've got this kind of the killer anchor where people need to come in until they start doing mail order for it, which could be coming on a broad basis soon. Who knows?
Okay.
They're doing that now. I have it set up for, I have an elderly mother that I went onto Walgreens.com and the drugs just ship directly to her every month. So they may be doing they may be moving themselves online to kind of avoid that.
Okay. Let's shift to office, if you don't mind. And then we'll do hospitality last. So over the next 12 to 24 months, obviously there's a lot happening in the office space. The asset class predominantly has longer term leases, probably has less exposure to incidents like we've seen. I know Trimont, we're a big consumer of office space, and while we haven't been in our 8 offices around the world lately, we're still paying. And we pale in comparison to JP Morgan. So I mean, I'd be curious to get your guys' thoughts in terms of how we look at office space here going forward for the next 12 to 24 months, maybe with office, because leases are longer term. It's maybe the 12 to 24 months isn't as relevant, but I'd still love to get your guys' thoughts on office and how do we think about it going forward, and are people really going to say, we only need half the amount of space, or are people going to say we need twice the amount of space because we need to have greater per square foot per employee for social distancing? How's office going to play? And then lastly, maybe if you could add a little color, if we have time, around urban versus suburban in there. Who'd like to start?
Well, I think on
I can start.
Go ahead, Erin, please. Yeah, please.
Yeah, just again, from the asset management side, we've been monitoring all of our office positions very closely. Unlike retail and hospitality that kind of took an immediate hit, office is a bit of a slower kind of process here in terms of, what it will be. We're seeing a lot of sponsors renew on a short-term basis right now. So their goal is to retain tenants. So we're seeing a lot of 6 to 18 month extensions of leases, just to give tenants time to figure out what they're going to do. Because to your point, Brian, I don't think anyone knows at this point. People are still working from home. People don't want to take public transportation. So we're seeing, you know, a lot of New York City offices, you know, at 10% occupancy right now. So it feels like sponsors are just trying to buy themselves time just to maintain their current rent roll. You know, the big question mark, you know, on our side for me is where are the new tenants coming from? Is anyone really expanding? And you know, everyone I talk to and all of our borrowers are like, we have no idea where these new tenants are coming from. Everyone has paused their, you know, search for office space at least for 12 months. Existing tenants want to downsize or vacate at expiration. So this is something we're watching super closely as to what happens to all this vacant office space, and then how do sponsors repurpose it. In terms of the repurposing, what we've seen pre-COVID, primarily in Texas for some reason, is the build out of these spec suites. And we found that tenants don't necessarily, you know, smaller tenants, perhaps those that are not wanting to commute into cities or to have their own space outside the home, don't want to wait for spaces to be built out. So there's a really high demand for spec suites. So these sponsors are putting in, you know, money to kind of build it out to minimal build out and have it ready so that when someone walks in, they're like, here's your office, here's the key. There's no build out time, there's no downtime. So I think, you know, having seen that succeed in certain markets, I think that makes sense, you know, for other sponsors, you know, perhaps not in major cities because people aren't necessarily coming back yet, but in suburbs, I think it totally makes sense to break up larger spaces and make it available to those that don't want to, you know, go into their primary office.
Okay.
We've been seeing in the city buildings that have 50% of the space are on the market because, you know, if you have an office that has a really diverse rent roll, a lot of people are saying, oh, I'm going to put my space on the market and see what I can get. But we were shocked at how much sublease space is on the market right now.
Is it affecting pricing?
Well, again, I'm not seeing a ton of New York City trades, right, on really diverse rent rolls, but I think it will. And I think, you know, if we get a vaccine, maybe those people will get back to the office and take their space off the sublease market. I think some of it's probably just a little bit of experimenting and seeing what the market will yield for them. You know, they're sitting at home getting sick of paying rent, but I think the future will tell us.
Okay. Elizabeth, you look like you want to dive in here.
Oh, no, I was going to say that we were talking about, Erin, you were talking about new tenants. The ones that I see in the marketplace currently are the ones where their lease is coming up in the next like 6 months. So they are feeling the pressure to be able to go ahead and make a decision to find new office space if they've decided that they're not going to renew where they are. Also, the tenants who are looking, it's funny, a lot, remember back not too long ago where it was very common to have the open space plan. You could put in, 50, 60 people in a very, very small layout. And now that is considered a very taboo, and people are now looking at, even on the sublease market, as many offices as possible to make sure there's only one person per office. People are very leery about even two people sharing a larger office. So that's what I've seen as a trend. That used to be, you would look for the open area, the 50, 60, stations, and then maybe open ceilings. And now that has changed dramatically, that everyone wants, that little silo of the offices, and not large conference rooms either. They just want enough so that they can be 6 feet apart, but they're not looking for a lot of wasted space.
So is this a breath of fresh air for suburban office?
Could be, yeah. Well, there's a lot of interest in suburban. Yeah.
With everybody moving, to Westchester County and so forth, are people going to say, you know what, I'm not going to come into the city anymore. I'm gonna keep, take my office now out in the burbs?
I think that's a shorter term view.
Mm-hmm.
but it is definitely a view of certain firms. Yeah, I mean, the large, urban centers, I think there's two big challenges. One is the public's comfort with public transportation, which may be the majority of people's way to commute into the office. And then two, for higher rise buildings, if you start to restrict elevator capacity and you have everyone back in an office in a 60-story building, you can't get everyone up to the office to work on time in the morning. It's just, you look at some studies, they say it could take till 1 p.m. and that doesn't account for people coming down. So, those are two big questions, and those of us who've been in, New York or San Francisco office buildings in rush hour, you're going to cram in, 10 people, as many people as you can in the elevator to get up to work. If that becomes a restriction, and so you've got the public transport question, I mean, those are going to take a while, because I mean, you need a scientific solution that the majority of people are comfortable with before that changes. And it's very hard to handicap, obviously when that is.
Yeah. Okay. Any other comments before we move on to hotels?
Well, I was just going to say that landlords also have been faced with a lot of extra capital needed to make everything touchless, to reevaluate the filtration systems and HVAC systems. So there's a lot of unanticipated capital outlay that we're seeing, especially in New York.
Okay. I mean, I'll just share this one story. I told this last week, but I'll repeat it. I have a good friend who's a 40-year partner in a big law firm, and corner office, the whole 9 yards, and he's on the litigation side. And this last 9 months, he said actually has been an increase in productivity for them working from home. In terms of his ability to get his job done and bill hours and do what he needs to do. He feels like he's just way more efficient, and that they, as a law firm, are beginning to really discuss seriously how they go forward and consume office space. I began my career as a lawyer, and I'm thinking to myself, dang, if the lawyers are now talking about reducing their office space usage, maybe there is a longer term implication there that might be happening that could be detrimental to urban office. But it was just one example of that comment. And so I guess it's too soon to say. Certainly, I mean, Jeff, to tie in your comments, I mean, it's the vaccine's going to be critical. I think, us getting through this is going to be critical. So if we may shift to hotels, and then I want to get to the capital markets in the remaining time that we have. To me, hotels feel like perhaps a little bit more brief discussion. I will suggest to you guys that I think hotels generally have been fundamentally crushed as an industry. I understand that there's some difference in drive to versus business. I'll tell you, at Trimont, we saw our drive to hotel business start to get better for a little bit, and then we started to see it tail back off again. And of course, the travel side of hotels has just been hammered. And I don't know how you get back, and how one underwrites now going forward for the next 12 to 24 months. Some semblance of recovery around hotels, but I'd love to get your guys' thoughts.
I feel like I keep repeating the same idea with it's very market focused, but we're looking at a deal in Texas right now that opened last September 2019. So it ramped during COVID, and it crushing how the competitive set did during 2019. So it's a hotel that has kitchens, and so it's kind of perfect for this type of environment. But then, there's other hotels that we would have told you were 40 LTV pre-COVID that would struggle to finance because it's located in a city and is a conference hotel. So I think everything is very specific to each asset right now. But I do think, we've seen in different markets, we're seeing kind of it get crushed. And then we've seen other markets where it's been a little bit of a steady ramp. Even the difference between New York to Philadelphia, when we look at how those markets performed throughout. Philadelphia was much steadier than New York was. But then you think of like, you didn't necessarily think of Boston as getting crushed by COVID, but when you look at RevPAR on a national basis, they were hit the most, which is, they're recovering now because they have the hotels filled with college students. But I think it's, you're going to have to look at each story very particularly.
Yeah. Well, look, I mean, generalizations, are definitely, real estate's a street corner business, right? So generalizations that any of us might make about real estates or markets or anything else are very dangerous. And I think it's a poignant reminder to the audience to remember that it's really dependent upon the specific circumstances of the piece of real estate that you're talking about. So thank you for that. Who else would like to comment on hotels?
I would say also with hotels, it's interesting to see, I don't know when the business will come back with all of the banquet part of that. Especially in urban markets, the banquet component is so important. And that is just non-existent. And I don't know when that will, maybe next 2 or 3 years, it'll start to come back. But when you have a gala of 1,000 people, I don't know when that aspect we'll see,
Sure.
Again, in the area.
Okay. Erin, I think you were about to say something.
Yeah, just speaking in terms of, the hotels on our books, transitional properties like going through a CapEx program or renovation. As Marilyn mentioned, it's really case by case, right? It's market by market. We have some hotels, outside of Manhattan that have been exceeding their budgeted numbers this year, which is unbelievable. Same with a hotel down in Southern California on the coast, and same with a hotel down in Pensacola that relies on, a military base. So it's really interesting. Conversely, we have a hotel in Denver, right, which relies on air travel and corporate travel, and that's crushed. So it's really kind of a tale of two cities here in terms of where the hotel is located. Is it reliant on corporate air travel, or is it, a driving market? And then, to Elizabeth's point, the food and beverage component is huge. We have a hotel, in New York City that has not opened food. The hotel's operating, but the food and beverage isn't open because it's so expensive to operate. They have to, operate outside. They don't want to purchase products, should it rain or they'd have inclement weather. So they've kind of, paused the reopening of food and beverage at this point. Also in the New York market, we have one hotel that has signed a contract with DHS, the Department of Homeless Services. So they've kind of paused their renovation, and they're kind of repurposing the hotel under DHS right now, which has guaranteed them certain cash flows. So it's kind of all over the place. You can't make a sweeping remark on hotels right now just because it varies so much depending on where it is, what it's for, and where the demand's coming from.
Okay, thank you. I'd like to shift the discussion in the limited amount of time we have left. Jeff, I'm going to start with you. I want to talk about the capital markets and how we underwrite the capital markets going forward over the next 12 to 24 months. And when I'm talking about capital markets, I'm generally referring to the cost of capital and the availability of capital. And how should our audience be thinking about it? Let's start with the availability of capital, and then we can all pull out our crystal balls and talk about the cost of capital. Obviously, we've had, if we level set, we've had unprecedented amounts of capital, both domestically and internationally. At Trimont, we've seen international capital flows obviously substantially decline over the last 9 months or so. But how do you guys think about liquidity, and then also maybe wrap in what are the alternatives? Where's capital going to go if it doesn't go to real estate for yield and so forth? So I'd love your thoughts there, and then obviously if you can weave in some projections of where you think maybe the U.S. central bank will be, or what forces are at play that might impact the cost of capital. And I'd appreciate that. We have about 5 or 10 minutes, and if we could wrap up there, I think that would really help the audience.
I kind of look at two charts, money supply, M2, and then money velocity. Money supply, M2, is at nearly all-time highs. And when you look at kind of cap rates, people talk about correlation to various, triple Bs and, treasuries, interest rates, so forth. But there is an extremely high correlation to cap rates and money supply. Money supply is high, and with the world awash in capital, I believe that's going to keep rates low. But then when you look at money velocity is very low. So not a lot of that money is sloshing through the economy as it should, which should keep a brake on inflation and also keep rates low. So I think the combination of those two, says inflation's not a worry, and it's not going to be one for some time. And you're going to see this low rate environment. There's more downward pressure on rates than there is upward pressure, really right now. So I think that's kind of the outlook that we're looking at the moment.
Okay, thank you. Marilyn, Erin, Elizabeth?
Yeah, I mean, I think that, obviously today was an interesting day watching the, when we talked on Friday, we're in a very different place than we are today, but, we still see a ton of capital chasing anything that's attractive. I think cap rates are remaining low, interest rates accordingly are also staying so low. Even during COVID, we didn't really see a repricing of risk reflected in the cap rates, right? They moved with the interest rates, but they didn't blow out at all. Certainly there were certain markets where things didn't trade, but cap rates still stayed pretty low throughout this process.
I was going to say that investors are still, in a fabulous position because of the low interest rates. So a lot of investors are going to really go after these deals. They may not be perfect, but they need some place to place the money. And I think you'll start to see, people will either bet on a location or not. You saw a major deal that was done with SL Green sold a building, close to $1 billion. And you wouldn't necessarily expect that in this marketplace, but it, again, flight to quality, and you have tremendous advantage in terms of the low rates.
So let's pretend I'm your operating partner, and let's pretend I'm presenting an investment to you. And I have now taken a 5-year investment thesis, and I basically have said, rates are going to basically remain where they are here, and my reversionary cap rate's going to be extraordinarily low because my interest rate assumption is extraordinarily low. How does that make you feel?
I think there are multiple. Oh, sorry, go Jeffrey.
Go ahead.
I think there are multiple aspects to that, right? Like, I think when we first started thinking about that, right, we're thinking about, are we reversionary cap rate being reflective of COVID, which I think it shouldn't be, because COVID, I got to assume COVID's over in 5 years, right? We're all vaccinated multiple times at that point. So then it just becomes, do you think interest rates are going up in 5 years? And I think what we're seeing is people are not assuming that, and the appraisals that we've been getting certainly are not assuming a much increased reversionary cap rate. We, of course, go through an exercise where we stress the coupons and say, okay, we're going to go to a more normalized interest rate environment for looking at this refinance, but it doesn't seem like on the equity side that's actually happening.
Okay. Who else wants to dive in here? Erin?
No, I mean, I'd say, I'm not an originator, but I know the deal teams that are looking at deals are finding it really challenging to win deals. So I think, the market is still competitive. People are viewing COVID as a temporary phenomenon, and people are anxious to get back into it. No one likes to be sidelined.
Right. Sorry, that maybe wasn't a fair question of you because of that. Okay. So what about the domestic versus international capital flows? dynamic. I mean, it seems like international capital has substantially pulled back. Is that a short-term thing, or do you think longer term?
I think short term.
Okay.
Yeah.
Okay. All right. So look, we're about at time. Rather than going through, the lightning round thing or what, a lot of panels do, I'd love to just take, 30 seconds each from you and just get some closing thoughts, whether it be from this discussion here or just a topic that perhaps I haven't covered. Anything that you're thinking about over the next year or so that you think is particularly interesting, or that the audience should be thinking about as they're looking at their investment decisions. Marilyn, maybe start with you. Is there anything you'd like to add on?
Sure. I think that it becomes important at some point for people to get back to the office and do it obviously respectfully of employees and tenants, but I think that we as real estate people hopefully can be leaders in that space. But I also think that that, as we saw in the market today, the idea of a vaccine feels like it's going to accelerate us getting back to the office regardless. We talked about SL Green, they halted trading today, right? Because they were doing so well. So I think that it feels like there's a lot of optimism in the market, and hopefully that quickly gets reflected to the real estate transactions happening on a more rapid basis.
Okay, thank you. Elizabeth?
I just think that we need to hopefully remain positive in terms of the market. I do believe that this is more of an 18-month or so setback in the marketplace, but I encourage investors to stay positive. You have great interest rates. There's a lot of properties that are available, and that could be a very good play for a long-term investor.
Okay, thanks. Erin, you next from the asset management perspective. Any pearls of wisdom for the audience?
Yeah, I mean, real estate markets go up and they go down, and right now we're a little bit down, but it's going to come back. Like we've been saying all along, it's just a matter of time. So I think if everyone kind of stay the course and keep their head down and, do new deals as they can and keep sponsors paying debt service, I think we'll all get through it. Hopefully sooner rather than later.
Okay. Jeff?
I think you're right, the pandemic has accelerated certain trends, but there's also certain fundamentals that are on pause that, I believe will come back. The reasons why people wanted to be in cities are still there. And, once we can achieve a medical, a scientific solution to the pause in that will resume. But there are trends like the trends in retail that we've seen, and, certain other trends technology-wise that were there pre-COVID and were accelerated and will keep going.
Thank you. Well, I guess I'll add my perspective as, a credit manager and servicer. I think 2021 is going to be very tricky. And I think that we could see quite a bit of volatility in the market. If you're in real estate, you generally should be long, and long, I think will prove rewarding. But I think we're in for a lot of uncertainties, and unfortunately for the Erin Wellings, the asset managers of the world, there's probably going to be a lot of work next year, and not only in terms of how you asset manage, but how you make your investment decisions going forward. And so I think it's going to be tricky. I would say be careful of people who generalize. I think is a good theme from this discussion, and really appreciate that it's very fact specific, and you have to look at all of the components that go into that investment decision very, very carefully. And if you're not sure, I would say don't feel like you're alone, because right now there's just a lot of unknown forces at play right here, and we're just in a lot of different uncharted waters. Would sort of be my 2 cents to add. So, and fortunately, as the moderator, I get to have the last word. So, with that, I would like to thank all of you, Marilyn, Elizabeth, Jeff, Erin, for joining. I'd like to thank NYU for hosting the conference. I wish everybody a great remainder of this calendar year. Let's all keep our fingers crossed for that vaccine and that we're all well and we all get back to work and are seeing each other again, because I miss seeing all of you. I miss seeing all of our workmates and doing these things when we're all rubbing elbows. So with that, again, thank you all so much. And again, have a great rest of your day and the remainder of the year. Bye, everybody.
Thanks, Brian.
Thank
Thanks,
you.
everyone.